Hello, e-commerce entrepreneurs. Welcome to Tax Talk. Today, we're breaking down the new digital tax law from Pakistan's Finance Bill 2025, tailored for online businesses. In 3 minutes, you'll know exactly what's changing and how to comply. Let's dive in. The Finance Bill 2025, presented by the Federal Board of Revenue, introduces a standardized digital tax framework for e-commerce. It imposes a 13% sales tax on all digital transactions, targeting platforms like Daraz, Amazon, and local online stores. This law aims to regulate the booming online market and ensure fair taxation. Here's what e-commerce businesses need to know. 13% sales tax, applied on all online sales, including goods and services, collected at the point of sale. Mandatory registration. All e-commerce platforms and sellers must register with the FBR's digital portal for tax compliance. Digital invoicing. Every transaction requires an electronic invoice linked to the FBR's real-time reporting system. Withholding tax. Platforms must withhold 1% tax on payments to sellers, adjustable against their income tax. These measures, highlighted by Finance Minister Mohammad Aurangzeb, streamline tax collection and curb evasion. How does this affect you? Expect higher compliance costs and stricter audits. Non-compliance can lead to hefty fines or account suspensions. To stay ahead, register on the FBR portal by July 2025. Update your systems for digital invoicing. Consult a tax expert to optimize your filings. This law pushes transparency but requires you to act fast. That's the new digital tax law for e-commerce in Pakistan. For details, visit the FBR website and share your thoughts in the comments. Like, subscribe, and hit the bell for more e-commerce tax updates. Thanks for watching, and see you next time. Upbeat music fades out. Text: Tax Talk, empowering Pakistan's e-commerce.